Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Emily Stromquist, Managing Director at Teneo, based in Washington, D.C. Emily, thanks so much for joining us today.
It's a pleasure to be here. Thank you for having me.
Well, great to have you and to get your your perspective on all things geopolitics and energy. Not just focusing on this region. We're going to have a bit of a global conversation today, but let's start by talking about the Middle East, of course, where we have seen, some terrible events unfold over the last 6 months. But let's focus a bit in on what that means for the energy sector, for disruptions to trade, economy, etc. And the one takeaway that we can come out with at least 6 months into this conflict and having seen, Red Sea disruptions and oil flows, etc., being disrupted there, is that we're not seeing much of an impact on the oil price, as we may have seen in another era, very differently. How do you explain that sort of, I suppose, unlikely result?
Yeah. So yeah, no, I mean, look, as you said, we're all very well educated on the impacts that geopolitics can have on energy prices, on driving volatility. And this conflict really seems to have defied expectations. For market bulls in particular, the signals and the reality haven't really lined up. The premium really does seem to be baked in somewhere around this $85 per barrel, give or take range. So, why is this? I think, it's probably a lot of the issues that your frequent guests are discussing, things like non-OPEC supply growth that we've seen, which has gone up considerably in the past couple of years, significant OPEC spare capacity. So there's not really concerns about, significant shortages. And I think on the flip side of that, the market is still very well supplied. There are high inventories. So there's not, and in terms of conflict, we haven't really seen significant outages. There not have been any kind of protracted outages in supply or significant disruptions. There's been rerouting that's had its own sort of set of consequences, but there's not been significant and sustained disruption. So I think the only thing right now that we could, conceive of that could drive up prices in a more sustained way would be, one of two things: either a more kind of aggressive or sustained attack that affected Hormuz, or probably some kind of conflagration of the current conflict, as has been sort of repeatedly discussed, that could draw in Gulf countries. And right now, given the number of talks going on the sidelines, the fact that, there's been plenty of reassurances that neither Israel nor Iran wants this to become a larger regional conflict, that doesn't seem very likely, but those are probably the factors that could kind of raise the ceiling at least a bit for prices.
Yeah, absolutely. And we have seen sort of a very muted reaction in terms of price. And that's, on the back of disruptions here. And as you said, we haven't seen oil stop flowing. But what we have seen, let's go west a bit to Russia and talk about, of course, we've seen disruption to the markets for the last 2-3 years there, but redirection of oil flows. But we have actually seen physical interruption, haven't we? Ukrainian attacks on Russian refineries, etc. Temporary, perhaps, disruptions, but nevertheless, we have, and we've seen some sort of, I suppose, result of that on the products markets. But what I want to ask you is what your opinion is on how the new US aid package to Ukraine may or may not influence Ukraine's actions and Russia's energy industry and that vulnerability.
Yeah, look, I mean, I don't think, 60 billion, it was a big, to get this package through. A lot of congressional debate about, what needed to be tied to this. But at the end of the day, the 60 billion isn't going to go that far in terms of changing the course of the conflict. This is really to keep Ukraine in the conflict, bolster up its defenses for the next 12 to 18 months. But it doesn't actually change the course of events with Russia. It's intended to keep Russia from achieving a large victory this year. But there's still no discussion about what an exit ramp looks like, what some kind of negotiated agreement could look like. So I think short of that, the 60 billion is really just about keeping Ukraine defended. And I think that, that doesn't really change the course of events for Russia right now. It doesn't change the outlook for its energy markets. So I think, the bigger question is more about, price caps and sanctions and whether those are going to kind of continue to have an impact or what kind of impact. And I think, on sanctions, obviously, Russia has frequently, proven itself resilient. There's been sort of historical trends of this. And I think when you look at the market right now, they have a very seasoned and capable central banker in Elvira Nabiullina. They've managed to, continue receiving sort of considerable oil and gas profits. Oil in particular, they've benefited from higher prices. And I think, they continue to make adjustments to taxes, to budget expectations. They just adjusted their oil price expectations in the budget. So they're doing what they can to try to patch over any of sort of the ongoing damages of sanctions. But, at the end of the day, sanctions are intended to be kind of a slow burn. And that's, I think that's often overlooked, is that they're not going to have an immediate and damaging consequence on the Russian market, but they do take a toll over time. We've seen sort of already, certain shortages in medicine, in sort of key components that go into repairing, technology and industry, including, for instance, refineries. And, I think we'll continue to see that sort of trend becoming more problematic, weighing more on the Russian economy. But if you look right now, the IMF has already adjusted their forecasts up for this year to over 3% GDP growth in Russia. That's a lot better than some developed markets even. And really a lot of this is on the back of wartime spending. So, Russia has to do some belt tightening. There's going to be sort of some consequences for the population of sort of ongoing conflict in Ukraine, but it's not taking that serious of a toll. And I think the other is on the price cap, where obviously Russia's built up a large shadow fleet. They've shifted a lot of their exports to China and India, found alternative insurance mechanisms. The P&I clubs just warned this past week about how this was, the price cap was really not proving effective on Russia, and the attestation system was very difficult for insurers. So I think, look, no major, on balance, sort of the conclusion of this, no major oil output changes. Russia has shifted, obviously, there's some tension with OPEC Plus, because as you said, Ukraine has started attacking refineries. There's been sort of unexpected maintenance that has had to be done. So this is certainly shifting more to the crude export side of the equation in Russia. But that's really the sort of immediate and near-term consequence, I think, that we're seeing from the conflict.
And yeah, great. And you mentioned OPEC Plus. I don't want to get too deep into the OPEC politics, but I wanted to ask you on that there is that relationship. Most people we speak to say, no matter what, Saudi and the other OPEC producers want to keep Russia on side. They want to keep Russia in the group, no matter what it's producing, exporting, etc. It's better that than not have it, cooperating. Let me just ask you, Emily, about Iran, just while we're on the topic of sanctions. Again, we had the US saying the last few weeks, because of the situation here in the region, that we may impose more stringent sanctions on Iran. Again, market very much dismissing that as being effective in any way.
Yeah, and I think there's a good reason for that. I mean, Iran is exporting more than it has in the last 6 years. That translates into about 35 billion extra that they're getting. Most of this, about 1.5 million barrels per day or more, is going to China. So I guess the issue now is that to really have an impact on Iran, sanctions would almost have to target the direct link with the China exports. And that's very unlikely, I think, particularly in the US administration right now. Biden is disinclined to pursue more of these sort of Trump maximum pressure types of measures. The US approach has largely been to target individual tankers for the time being. But as we all know, Iran is quite good at evasion, finding the loopholes, spoofing. So this has had a very limited impact. And, it's hard to imagine that even a tightening of US sanctions on Iran right now would significantly impact that flow of crude to China that's going on.
Yeah, I mean, well, let's talk a bit about China, Emily, but, in the context of its relations with Iran, with the Gulf, with the US, and then you have the Saudi-US relations and all these sort of bilateral relations, I suppose, that have had traditional sort of contexts and models and changing quite a bit as the regional sort of economic order shifts, whether because of the war that we have today in the regional tensions or attacks, or whether there's just a general eco shift, if you like, east. How do you see all of these coexisting? I mean, particularly China, for example, last year was seen very much behind the scenes to be helping with the Saudi-Iranian détente. That's kind of paused for now for obvious reasons. And then you have Saudi and the US relations. Let me put it simply then, having put that context, US role in the Middle East and with regards to how this region also relates to China. Is that changing? Do you see that evolving, and how in the future?
Yeah, absolutely. I think, each of these factors is really a reflection of shifting macro trends, and sort of each of these bilateral dynamics in turn are going to kind of shape what a new norm looks like. So I think the big picture is that all of this is really part of a new economic and security architecture. We're seeing a shift away from US unipolarity. We're seeing a battle for influence between the US and more revisionist powers like China, like Russia. And then kind of along with that, also the emergence, obviously, of non-state actors who are testing the waters and attempting to maximize their interests. So I think there's sort of several big dynamics here. It's obviously US-China. This is going to be a huge election issue in the US. Biden has been criticized very regularly for being soft on China. I think in the run-up to the elections, this TikTok ban could have, a significant role in disrupting the rapprochement that we've seen in US-China relations recently. There's the China-Russia dynamic, which obviously was kind of defined as a no-limits partnership following Russia's immediate invasion of Ukraine. But it's very much run up against certain limits, as Western financial sanctions have had an impact on strategic thinking inside of China about, how to turn around the economy, how to boost growth. And then the other key component, I think, of this sort of big picture shift would be the US-Saudi relationship in particular, but US Gulf relations in general. And the deal that the US is trying to get done with Saudi right now obviously has hit some potential roadblocks. The question about how Israel will factor into this, what sort of Congress would accept as a reasonable deal, will all have an impact. But I think kind of the underlying takeaway from that is that if and when a deal does get done, I think this would kind of shift the narrative again in the Middle East. There has been one of diversifying foreign policy, diversifying trade relations in recent years, particularly as the US has kind of withdrawn its security presence in the region. I think a new deal, if it gets done with Saudi, would very much kind of reinforce that relationship with the West again, reinforce that sort of US and Saudi relationship, and probably have some consequence, I think, in terms of the extent of relationships, particularly with China and the Gulf, where it, again, focuses much more on energy market trade rather than, sort of specifics of technology, security, and sort of other dynamics that had been under discussion.
Okay, thanks, Emily. We could go on about that. These bilateral relations, we need a session on each of those, but let's move on a bit. And talk a bit about back to the energy markets focus, but in the context of energy security and geopolitics, let's talk a bit about energy transition, because we've seen, of course, the economies here, the Gulf countries investing billions in energy transition, being an oil and gas producing region, and of course investments in America through the IRA Act, etc. Do you feel that the last 2-3 years, as we've had geopolitical tensions heightened in the markets, if you like, that energy security has pushed the energy transition to the side a little bit? Where's the commitment to that going forward? Where are the hurdles, even from a finance point of view, do you think, for the future of that and policy?
Yeah. Look, I mean, always a tricky question. I think certainly energy security has been granted more weight in recent years because of Ukraine, because of ongoing conflict in the Middle East. But that being said, oil and gas activity is certainly growing, and decarbonization considerations also are not going anywhere. So we're moving toward, clean energy for sure. The interests are certainly accelerating. Costs continue to fall. There's expected to be, maybe a doubling of clean tech additions through to 2030, and the price per kilowatt hour is expected to come down some 20%. So certainly these are kind of the conditions that would encourage, considerably more investment into clean tech and a much larger scale rollout sort of globally. But I would also say this is really a pivotal moment for energy transitions. I think the energy transition itself is undergoing a transition, navigating this multipolarity that we've discussed. There's weaker global leadership on multilateral platforms. This has driven a sort of divergence in national policies. You see the EU and the US testing out these kind of stick versus carrot approaches. There's no real consensus about what the sort of appropriate energy mix is as we sort of embark on these sort of transition paths. And so in this context, industrial competitiveness, I think in particular, is becoming a real concern, and that's driving protectionist policies. There's a lot of concern that if you pick the wrong path or the wrong policies, that this is going to sort of significantly affect, how industries will be able to function globally, especially those that are multinational institutions and have, supply chains across the globe. So I think in terms of this broad question, that means different answers in different markets, and a lot of it depends on geopolitical risk exposure and on comparative advantages. But I think, to really push the transition along, there also have to be clearer policy signals, and that's where there's a significant gap across the globe right now. There's no multilateral institution pushing a really comprehensive narrative. There's no sort of favored technologies that are sort of, there's no strong enough signals about the preferred technologies, and the market hasn't yet picked sort of where it's going to land. So I think it's a very difficult time for energy transitions, but they're certainly not going anywhere. And we are seeing a lot more capital being committed. And I think, this really depends on governments turning to the right policies. And we're seeing that tested in the EU with the Green Deal, in the US with Inflation Reduction Act. And I think there's a lot of sort of lessons to be learned from these policies. And there could be, a number of ways that this can also push productive investment and reassure investors about sort of which technologies and policy directions are most likely.
Yeah. And of course, part of that calculation being made by oil producers, whether they're NOCs or even IOCs, the likes of Shell, BP, et cetera, who again, we've seen kind of, be a little bit reticent on their previous commitments to how fast they're going to be sort of investing in alternative green energy, if you like. Part of that calculation that energy suppliers make is, of course, demand, right? It's about immediate demand for oil and gas from emerging economies as well, especially. And this whole debate around when is peak demand for oil going to come around, when is, gas is, of course, part of the transition story. So, again, we see divergences on that argument more long term, but even on the more immediate, like what is demand going to be this year for oil? What's, between, and I know that different institutions talk their own books, but economically speaking, and the macro picture is getting more confusing, isn't it, in terms of how it's going to be influencing demand. For example, interest rate policy from the Fed, which in the last 2 months has taken a 180-degree turn. How are energy markets meant to plan accordingly?
I mean, that is the big question. I think if I had an answer for you, we'd all be doing very well. But I mean, look, I think there's a lot more going on right now than just sort of being unable to get our heads around what the global oil demand picture is. It sort of does, as you say, get to sort of this energy transitions aspect and the role of clean tech. There's a lot of points of divergence around what renewables investment levels will be, the Chinese economic outlook, electric vehicle penetration. And I think without sort of clear answers and signals on some of these issues, it's very hard to sort of then project what peak oil demand is going to be or when that's going to happen. More immediately, obviously, we're navigating this very difficult world of inflation at the moment. At the end of 2023, central bankers were very much at odds about the right response to energy price volatility, especially following October 7. And it's very difficult because energy prices are such a nuanced piece of inflation. Central banks can't really easily control prices with sort of any interest rate hikes. And so all eyes are kind of on the Fed right now. This higher for longer policy has led to many of the major economies holding their own rates for the time being. I think that's very much in the immediate term going to dictate the pace of things. But overall, I think the sort of peak demand is a very difficult question to answer with all of these sort of individual factors that need to kind of each be sorted out in time. So I think we have to start with the central banks and the inflation piece, clearer policy signaling, and then in time that will kind of get us to that sort of clearer forecasting of peak demand.
And what is your sentiment sitting in the US in terms of the economy there in the USA? Obviously, still performing well. Employment figures are still strong. Inflation has come under control. It's not at the 2% target, but it's under control. What's your sense of what the second half of the year looks like from an economic point of view? Seeing stock markets still perform very well, et cetera, et cetera. Is there any signal that things are slowing down?
Yeah, I mean, look, I think, we certainly all signs, as you've mentioned, all economic signals are pointing to the fact that, this inflation downtrend is certainly alive and well. But I think the key issue right now is just the uncertainty about sort of the pace at which some of these key changes are going to emerge. And, not only that, but the global impacts of any decisions that are taken by the Fed. So I think all signs do probably point to gradual Fed easing, but the election year and sort of the degree of sort of politicization of every sort of key decision that's being made right now makes that outlook much more difficult. I mean, I think, with energy price inflation, the US will very likely resort to use of SPR to try to keep that under control, the Biden administration. That's one of the biggest political issues and concerns in the run-up to the elections right now. So I think there's a lot of, just general uncertainty, from housing market to energy prices that really is again, no clear signals or direction yet. And until sort of some of that does clarify, there's going to be, some pressure on the Fed about when is the right time to start lowering rates. And I don't think we have sort of that clear indication yet.
Okay, I mean, just going east of it, just to China, you mentioned the TikTok ban, just like to bring in that's US-China relations and the whole tech trade, I suppose, tit for tat. But just, I know I'm not going to grill you specifically on China economy, but again, that is a huge consumer of energy. And it has had, an okay, reasonable year last year, still some challenges within a couple of its sectors. But from where you sit, what is the outlook for the Chinese economy from the information that you have? Should energy markets be confident that will continue to give the base sort of pull of demand that it needs as its economy, obviously goes through some major restructuring?
Yeah. I think there was sort of one bright spot over the past quarter where exports started to go up. They're still very much grappling with lower investments. The property and housing market has been problematic. Still low growth. And I think these problems are kind of going to continue to persist for the time being. So again, doesn't look like, we're yet at the point of sort of a significant turnaround and strong growth. The government has been, somewhat reticent with policymaking. There's not been sort of a significant move to do large scale interventions in the market right now. So I think, short of that, I wouldn't expect sort of a significant shift, I think, in our line of thinking on China at the moment. But certainly, the potential is there. The eyes are on, sort of the vulnerabilities in the market and what can be done to turn that around. I think, the fact there was some improved Q1 data does suggest, that we could see, some turnaround later this year. But I think really the elections in the US are probably still going to be one of the absolute largest risks. Biden has obviously, continued to go with somewhat of, or a number of the policies that were introduced in the Trump era. But I think, one of the biggest risks is that, a Trump presidency would, he's threatening to revoke their permanent most favored nation status. That translates into at least 60% tariffs on Chinese imports into the US. And that would have obviously considerable knock-on effects on the Chinese economy as well. So I think the fact that China is also such a critical part of election politics this year in the US does have sort of some significant weight in terms of sort of what the sort of perceived outlook is for the Chinese economy as well.
Yeah, it's going to probably be one of the most interesting US elections in quite a while, isn't it? So many things influencing that very marginal tilt one way or the other. Emily, before we let you go, I wanted to go back to Russia and just ask you, because that is one of your specialties, and ask you a bit about gas, because of course what we saw post-Russia invasion of Ukraine 2.5 years ago is Europe quite quickly, sort of weaning itself as much as it could off gas. Obviously, we had a cost of living and cost of energy crisis for the first year, but then things seem to calm down. Of course, Europe has also a very strong transition agenda, but that's more long term. Some people are of the opinion that we'll never go back to reliance on Russian gas, and others say, why not? Once the Ukraine-Russia war is over, Europe will continue to diversify its supply. What's your opinion there?
I mean, look, Russia was always the lowest cost supplier. It's very easy to send cheap Russian gas to Europe through pipelines, but that has taken a significant hit. The Russian reputation has taken a significant hit in light of the conflict. I think, if you're going to be bullish on the outlook for Russian gas in Europe, you're assuming a sort of fairly rapid and smooth conclusion to this conflict in sort of the next year or so. And I think that's very difficult to imagine. Otherwise, Europe has certainly doubled down on finding alternative suppliers, and particularly on LNG. With a lot of new LNG growth coming into the market, that certainly does give Europe more optionality. There could, yes, definitely be a place for more Russian gas in the future, but there's a lot that's up in the air now too. Obviously the transit contract with Ukraine runs out at the end of the year. Russia's already shifted to selling more LNG, so it depends, as well, whether sanctions take a heavy toll on Russia's LNG industry. So I think that's a big question. Obviously, Gazprom has just posted its first net loss since 1999. So the company is certainly struggling right now under current market conditions. Some of the early day contracts with China were probably not the most sort of beneficial supply contracts for Russia. So negotiating sort of expansion of those supply agreements with China, I think there's very limited opportunity on Power of Siberia or some of the other sort of discussed, proposed but never realized pipeline deals with China. So look, I think, it's not a particularly promising outlook, I would say, for Russia's gas industry. Certainly getting, necessary parts to do repairs for LNG facilities is going to be increasingly difficult. Not something that they can turn to China quite as easily as they can, for refineries and other sort of oil industry needs. So I think it is a big question mark, and I think a lot of it will really hinge on what kind of a deal gets done, if it does, between Russia and Ukraine, and what that resolution looks like, how much it's costing the West, and sort of how much pain has ultimately been inflicted. So yeah, a lot at stake, but also a lot of options for Europe these days that sort of make that slightly less painful than it once was.
Emily Stromquist, Managing Director at Teneo, thanks so much for joining us today on Halftime Talk.
Great to be here. Thank you so much.